Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menasce. There's been a lot of discussion over the last several months about tariffs and the trade relationship between Canada and the U.S. The events of Friday, where Canada withdrew from the negotiation, puts the impasse in stark terms. Most of that discussion has been focused on manufacturing, on automobiles, steel, aluminum, and certainly politics. The trade war is clearly escalating. Tariffs are just the start. What happens if the nations take the even more drastic step of withholding exports to each other? Major parts of the U.S. are dependent on Canada for critical resources, for electricity, for energy. We don't know where this will end, but underneath all of that is a more practical question for real estate investors. What happens when a trade dispute starts changing the cost of building? Canada is an important supplier of construction materials to the U.S. Lumber is probably the most obvious example, but it goes well beyond lumber. Steel, aluminum, cement, plywood, a number of manufactured products cross the border every day. The trade dispute also puts the agreement with Mexico in uncertain territory. Some of the products are easy to replace, others are not. Cement is a good example. Cement is heavy, it's relatively inexpensive by weight, and transportation represents a meaningful part of the delivered cost. So if you're building in a northern state and the closest economical supplier happens to be in Canada, replacing that supplier with one that might be further away may solve the tariff problem, but create a freight problem. The economics don't disappear, they just move around. The folks at Cushman & Wakefield recently estimated that the tariff environment had increased commercial real estate construction costs by about 6% compared with the 2024 baseline. They estimated the impact on the total project cost at about 3%. Now, at first glance, 3% doesn't sound dramatic, but development economics are not measured against total project cost, they're measured at the margins. Imagine a project costs $50 million and it's expected to create $7 million of value. If that project cost increases by 3%, that's another $1.5 million. The project didn't become 3% less profitable. The development margin fell by 20%. That's a very different way of looking at the same number. The more interesting issue, though, is not just the absolute increase in cost. It's more like the uncertainty. Contractors have always dealt with changing prices. Lumber goes up, it goes down, steel changes, labor costs move around. That's normal. What's more difficult is when the contractor doesn't know what trade rules will apply by the time the material is purchased. A contractor might prepare a bid today based on one tariff structure and then purchase the materials in 3 months under a completely different tariff regime. That creates an awkward situation. The contractor still wants the job, the developer wants certainty, and the lender wants a construction budget that appears to be fixed. And the subcontractor supplying the material might be only willing to hold the quote for 10 days, and suddenly a guaranteed price isn't as guaranteed as it looks. We're seeing more discussion in the construction industry around a very short shelf life for a quote. Various escalation clauses, contingencies, and exclusions. That doesn't necessarily mean contractors are trying to increase their margins, they're just trying to protect themselves. I was thinking about this recently because development budgets often compress all of the risks into one number. You might see a construction contingency of 5% or maybe 7%, but risk doesn't necessarily behave that way. A tariff on Canadian lumber doesn't increase every line item by the same amount. A change in steel pricing doesn't affect drywall. A change in cement pricing might matter a lot to one project, not at all to another. And a piece of mechanical equipment with a 9-month lead time carries a completely different form of risk. So the trade war is creating a very uneven effect when it comes to construction. There's also a second side to the story. Higher construction costs are obviously not helpful if you're trying to build something today, but they could have a second-order effect if you already own finished product. If a new apartment building becomes more expensive to construct, some projects that were marginal, well, they're just not going to get built. But if fewer projects start this year, there might be fewer units delivered 2 to 3 years from now, and that can reduce future competition for existing properties. We saw a version of this after the large increase in construction costs following the pandemic. Projects that worked at one cost basis suddenly stopped working at another. The impact was immediate and painful for developers. The longer-term impact was lower new supply in certain markets. So the same tariff can be negative for one real estate investor, potentially positive for another. The developer is dealing with higher replacement costs, but the existing owner may eventually benefit from that same higher replacement cost. That's why broad statements about tariffs being good or bad for real estate doesn't tell us very much. Real estate is too local for that, and so is construction. All of the elements of the entire supply chain are local too. Even the availability of substitute materials could be local. So the trade dispute between Canada and the U.S. is clearly an evolving story. It's changing by the hour. But one thing is already clear. The impact is not just a tariff percentage being added to the price of a building. It's showing up through material costs, through contract language, through uncertainty, and through the number of projects that will make economic sense. As you think about that, have an awesome rest of your day. Go make some great things happen. And we'll talk to you again tomorrow.